You're about to listen to the Yet Another Value podcast with your host, me, Andrew Walker. Today, I am going to be doing an update on the 3 ideas that I kind of solo presented to you guys over the first half of the year. That's an update on Sage Therapeutics, that's an update on Keros, and that's an update on Full House Resorts. Disclosure, I am long all of these stocks. I give a couple more disclaimers in the podcast. There's a full disclaimer at the end of the podcast, so remember that. Updates are always interesting. I know there's been interesting news at all of these companies, so I wanted to take a second and give those updates, kind of put a bow on 2 of the 3, and give an update on where everything stands. I'll let you get to that. I hope you listen to it, and I'll let you get to that. But first, a word from our sponsors. Today's podcast is sponsored by Dalupa. Are you still manually updating your financial models after earnings? Ask yourself, why? Every quarter, analysts lose hours copying numbers from filings, adjusting templates, and double-checking for errors. It's tedious, it's time-consuming, and it's a terrible use of your time. Dalupa changes that. They automate your model updates with near real-time precision, using AI that's been trained on thousands of companies' filings across every sector. The result? You get a fully updated model in your format with your logic faster than ever before. Every KPI, every footnote, every guidance figure, exactly where you need it with source links built in. So stop wasting time on data entry and start focusing on what really matters: analysis, insights, and alpha generation. Dalupa doesn't just save your time, it gives you time back where it matters most. Book a demo with the Dalupa team today at dalupa.com/demo. That's Dalupa, DALOOPA.com/demo. All right. Hello, and welcome to Yet Another Value podcast. I'm your host, Andrew Walker. Today, I'm going to be doing a quick update. One of the most popular requests I get on the podcast is, hey, you had guest XYZ on to talk about stock ABC 6 months ago. Let's get an update. The stock's down 20%. It's up 100%, whatever. Let's get an update. It's hard to get guests on to do the update. But one of the nice things when you are the host of your podcast and you come on every now and then and talk ideas on your own is you can force yourself to come on the podcast for updates. So today is July 7th. I pitched 3 ideas throughout the year, solo pitches where, I get on here and talk about an idea for 30 minutes, 20 minutes, an hour, 5 hours, who knows. But today I'm going to be doing an update on the 3 ideas that I talked about so far this year. Those are Sage, Keros, and FLL. The full disclosure, I am long all of those stocks. And on top of that disclosure, I'll add a disclaimer that nothing on this podcast is investing advice. There's a full disclaimer at the end of this podcast, but I'll remind you of 2 things on the disclaimer. Again, I'm long all 3 of these stocks. And the second disclaimer is, hey, last week I do a random rambling every week, and I forgot to turn the microphone on. So for 30 minutes, it was just me waving my arms like crazy and saying nothing. So that's a waste of 30 minutes. That's 30 minutes I'll never get back. And just ask yourself, hey, this guy claims to be a professional, semi-professional, whatever it is, podcaster. He can't turn a microphone on. Should I be listening to him about anything? Probably not. So those are the disclaimers. I'll just give there's a slide. Oh, by the way, for those of you who normally listen on audio, I try to make all of these audio only, no visuals. But, when it's just me coming on, talking about an idea for 20, 30 minutes, whatever, it can help to have a little bit of help. So if you normally do audio, if you want to come over to the YouTube and watch the video, might be helpful. I have some slides that are literally just screenshots of SEC filings. But if you want to hop over to the YouTube, you can see those. But I'll try to auditorially explain everything, so I don't think you'll miss anything if you listen on audio. Anyway, while we're at it, disclaimer, there's a disclaimer slide that I'm showing on the YouTube. I gave you the disclaimer online. You can go to the end of the podcast and listen to it. Let's hop into it. So far this year, I have done 3 what I call solo ideas. It's me getting on and talking about a stock, a situation. For all 3 of these, again, I'm long. I've thought about doing stocks that I'm not long, and I might in the future because, as I've gotten increasingly into corporate governance, you can go down some deep and very dark rabbit holes, and I might try to shine a light on some situations. But the 3 ideas I've done so far is episode 283. Right at the start of the year, I did my Full House Resorts idea of the year for 2025. Episode 292, I did a special situations on Sage Therapeutics. And episode 305, I did avoiding the zombie biopharm trap at Keros. I'll include a link to all of those episodes kind of in the show notes or in the links or whatever if you want to go listen to those episodes. On top of those 3 ideas, I also did an open letter to the Sage board that I published on May 1st of 2025. I'll include a link there. You can go read it. And I said, hey, Sage, I did this. I did this original podcast on it. And when I did the Sage podcast at the time, the idea was, hey, I look at Sage, and Sage had been put into play by Biogen. Biogen had made them an offer, and I said, Sage, you have two options. It makes complete sense I called it the good girl route with along the lines of my dog Penny. You can be a good girl like Penny is, and there was more to it than that, but you can do what's right for shareholders, and you can run a process and sell yourself to the highest bidder, or you can be a bad girl. And you can, because your board of management own nothing, you can refuse to sell yourself and burn all your cash and burn this company to the ground. And I published the podcast hoping they'd go the good girl route. I published the open letter when it seemed to me like they might want to go the bad girl route. And fortunately for everyone, as we'll discuss, it kind of has ended up for the best. I also published an open letter to the KROS board on May 9th. 2 open letters in a week. It was an exciting time. KROS open letter, extremely similar to the Sage letter. Look, you're a subscale biotech. Your lead drugs have failed. You need to do what's right for shareholders. So those are kind of the public things that I've done. I'll include a link in all the show notes for all of them. So I just wanted to give that background. So we're going to talk Sage. We're going to talk KROS. We're going to talk FLL. Let's start with the easiest company to update. That company is Sage. The thesis here was Sage in early January. Biogen had put Sage in play. Sage's stock at the time was low fives. Biogen offered low sevens per share. I went in my podcast in my open letter and said, look, Sage should no longer be a public company. The value to an acquirer is much higher than the share price as is. I think the company needs to sell themselves. And I've got on the slide here, winner, winner, chicken dinner, because earlier this month, Sage entered a deal to sell themselves for $8.50 per share plus a CVR. Now, here's the thing. They're getting acquired. This is the simplest story because guess what? In 6 weeks, 8 weeks, Sage isn't going to be a public company anymore. They're going to be gone. They're going to be off the board. But I'm not just doing this update to take a victory lap and spike the football, even though it is a little bit of that. I've been told by people, hey, if you're going to rub your nose into losers, and God knows I'll rub my nose into losers, you need to celebrate the winners a little bit more, be a little more public. So yeah, I am spiking the football a little bit, deal with it. But I don't think it's the end of the story here. So Sage is getting acquired by Supernus. Supernus is a nice pharmaceutical company. I don't know a lot about them. They are paying, if you're on the YouTube, I've got screenshots of the press release. Supernus is paying $8.50 per share plus a CVR. The $8.50 per share, let's focus on that. If you read the proxy statement, the tender docs, and you should, I did a full deep dive into the tender statements because they are some of the craziest tender statements I've ever seen on the premium side. I won't dive into it too far, but if you read the tender statement, the CVR is kind of, there's a lot of milestones. Only one of the smaller milestones really likely to get hit. I think that's interesting in and of itself, but let's just focus on the cash portion. Supernus is paying $8.50 per share in cash. That's $561 million. That's interesting. Why? Because Sage had $424 million of cash on their balance sheet at the end of March 31st, 2025. Call it 400 after cash burn when the acquisition goes through, whatever. However you put it, Sage is getting acquired for, the equity value is, as I just said, $561 million. Sage is going to have, call it $400 million, whatever. Sage is getting acquired for less than $200 million enterprise value. That's really interesting to me because if you read Sage's tender docs, they had a royalty deal that would let them borrow $200 million against their lead drug. So Sage is getting acquired for less than the royalty financing that this lead drug was worth. And I'm calling this the dog that didn't bark because if you'll recall, for my original podcast, my original thesis, the best buyer, the only buyer who makes any sense for Sage is Biogen. Because remember, Sage is two assets. They're a pile of cash and they're the JV asset that JV'd with Biogen on Zurzuvae. It makes absolutely no sense for any other buyer of Sage to be the buyer, except for Biogen, because Biogen can take that 50-50 JV and collapse it. There's huge synergies there. They know the asset best. There's some niche cases where a royalty buyer might be a better buyer of Sage, but put those to the side. No operating company should be buying Sage except for Biogen. I call this the dog that didn't bark because if you read the tender docs, Biogen is not involved in the sales process at all after they kick off the sales process. And I remain firmly convinced that Biogen is the best bidder here. So what I would say is I don't think this story is over. I think Biogen will be heard from. I think there's a decent chance that Biogen comes up with a topping bid. Again, I'm recording this July 7th. The tender docs just came out late last week. It's possible that, I'll probably get this up July 9th, July 10th. Tomorrow's Monday. It's possible Biogen comes with a better bid on July 8th. It's possible it comes a week after, 2 weeks after. It won't be 3 weeks after because the tender will be done. So they're going to have to move pretty fast. I anticipate they will. Again, the fact that this company is getting acquired for less than a royalty buyer was willing to finance this drug, to me screams that this is a bid that's designed to be beat. And I would just say one thing. Look, Biogen is the best bidder here. I've got a screenshot here from Biogen's Q1 earnings call. They do the typical IR thing where the IR person comes on and says, welcome to Biogen's Q1 earnings call. And then the CEO comes on. He says, hey, we've got a new CFO. Welcome. And the first drug he mentions, literally the first paragraph, first drug he mentions by name is Zurzuvae. And I would say two things. Biogen, we have two options. Number one, if you can't pay more than a royalty company was willing to finance Sage's share of this key drug that you mentioned, the first thing you mentioned in your earnings call, there's two options. Number one, your shareholder should say you are full of baloney. You should never mention this drug again. You have no belief in the value of this drug. Absolutely not. You can never mention it again. You think it's basically a worthless drug, right? That's option one. Option two is, guys, your discount rate, if you can't top what a kind of royalty financer would bid with all your synergies and everything, if you can't top what a operating company who's going to have no synergies when they take this JVN, if you can't top that, you can never do M&A again because you guys are the worst acquirers of all time. You have no clue how to value a company. You have no clue how to evaluate synergies. You can never do M&A again. It's one of those two options if they don't come over the top for Sage. That's bluntly how I would put it. It would be absolute insanity to me if Biogen didn't come over the top. And the only reason it could be is if Biogen is full of malarkey when they mention Zurzuvae in public, or if the management team is absolutely brain dead when it comes to M&A. So that's Sage. Last thing I want to point out here. Again, I'd encourage you to read the tender docs. I published a full post breaking down. It's some of the most interesting, fascinating, crazy tender docs I've ever seen. But I wanted to point out one thing here. When you read Sage's tender docs, there is an interesting line that says, as Sage's strategic alternatives process progressed, certain stockholders also wrote to the board expressing frustration with the length of time the process was taking, given Sage's continued cash utilization. And I would just like to say, thank you, Sage's board. It's nice to be seen in the proxy. I say that facetiously. But the real thing is, look, people ask, why do you do these open letters? Why do you publish the podcast? This is the reason. Companies need to hear from their shareholders. If you're a shareholder for one reason. You want the stock to go up. You want the stock to work. You want the company to be more value. You want to maximize the value. Sage's board was clearly feeling the heat from their shareholders. I am one. I've disclosed that. I think that people, when they heard the podcast the first time, when they saw my open letter, I think they contacted the board and let them know what their views were. And I'm not trying to form a group with anyone. I just believe in good shareholder engagement. This is what you're doing it for, right? You want the board to feel a little bit of heat. This board who doesn't own any stock, who, in my opinion, would have preferred not to run a process, continue collecting paychecks, continue collecting everything, have the prestige of being on a board. They wanted the status quo. The only reason they don't have the status quo, one of the reasons they don't have the status quo, is they were feeling extreme heat from shareholders. And yes, there were some shareholders that were larger than me, larger than any of my listeners, who I'm sure were putting just as much pressure on the board. But the fact is, 50 small shareholders writing letters to the board, reminding the board of their fiduciary duty, that carries a lot of weight. So I just wanted to call this out when people say, oh, these open letters, these podcasts, they're silly. In my opinion, they're not. I don't think they were in Sage's opinion. If you read this tender doc, I think it was a real needle mover in kind of getting the process going. And later on in the process, you would see, if you read the backgrounds of the tender docs, they start referring, hey, we need to get this process done before the annual meetings takes place. I think the shareholder engagement, they realize the annual meeting is going to be embarrassed for us. If it goes on beyond the annual meeting, it's going to get really embarrassing for us. So I do think good, engaged shareholders can really impact a process and help drive a good outcome. Doesn't mean it's guaranteed, but I think it certainly helps. And this is just one thing I would point to, one example of that. So that wraps up Sage. I'm probably never going to have to talk about this company again because, again, in 6 to 8 weeks, they'll be gone. I expect that they will be gone to Biogen, will make a topping offer, and they'll be going to Biogen. But it's possible they go to Supernus, and if so, Supernus is going to have made an incredible acquisition because they acquired Sage for an absolute song after the cash and the value of the Zurzuvae asset were taken to account. Let's move on to KROS. Look, KROS, great timing on my end. I basically published the podcast from memory. I published it on a Wednesday in early April, and on Thursday or Friday, KRS came out and announced strategic alternatives. So great timing on my end. The stock has gone a lot higher, but I'll be honest with you. This is a nice start. I think there's more to go. So if you're watching on YouTube, I've got a clip from the announcement of the excess capital return that Keros made when they concluded their strategic alternatives. And they said, hey, we're returning $375 million to shareholders. That's a nice start. Keros had $720 million of cash and equivalents on their balance sheet at the end of Q1 25. Are they burning cash? Yes. In my opinion, cash burn is way, way too high here. This is a company whose key late stage products either failed or have been partnered. They have one early stage drug and a couple of preclinical drugs. A company with one early stage drug and a couple of preclinical drugs does not need 300 plus million in cash on the balance sheet. It's not only extremely inefficient, it's a sign that the management team wants to go and do a lot of things that, in my opinion, are suboptimal for shareholders. So with KROS, I'd say, hey, we've had a nice start. The company announced strategic alternatives, but there is more work to be done. First, while they said, hey, we're returning 375 million, they haven't announced how they're returning it yet. They haven't decided how they're returning it. Are they going to do a tender offer? Are they going to do a dividend? Are they going to do something I haven't dreamed up yet? I don't know. Probably can't tender offer a dividend because there's only so many ways you can return cash to shareholders. I guess accelerated stock repurchase stuff. But, I would just note that there's more work to be done because I think the company held on to too much cash. I think the company needs to significantly bring down its cash burn. I think the company needs to look at ways to return some of the partnership value that they have to shareholders. So nice work so far. Again, if you remember my first podcast, I did it and I published the open letter because I became increasingly concerned that the management team and parts of the board were not aligned with shareholders. So I think there's more work to be done. I think more cash should be returned. I think the company needs to explore bringing the cash burn down dramatically. And I would just note, I don't think I'm alone in this. What I've got here is a screenshot from alongside the capital return. They published the results of the annual meeting. 3 directors, this is a staggered board, 3 directors ran. One director who belongs to their largest or second largest shareholder received an overwhelming number of votes for. The other 2 directors, one of them, if you add up the votes withheld and broker non-votes, she basically, I believe, should have resigned on the heels of this. And the other director, very, very close call between the votes, basically 50-50 votes for and votes withheld. Given that they had a support agreement with one shareholder, I think this was a disastrous result for the board. I think it's one of the reasons you got 375 million back. I think it should have been more. I'd note, I'm not from any group, but ADR1, who is now Keros' largest shareholder, published a PR that said, hey, troubling results of 2025 director election, insufficient capital return. I agree. I think if shareholders keep the pressure on the board, given those board vote results, I don't know how the board would not get the memo here. And I fully hope and expect more capital to be returned to shareholders in the near to medium term. And if not, given the shareholder vote results, Godspeed to the non-aligned directors at the next meeting. All right, let's go to the last company I want to talk about, Full House Resorts. So look, we did 2, it's fortunate timers, small sample size, all that. We did do 2 winners with Sage and Keros to start. Let's go to Full House Resorts and let's rub my nose in it. So far, this was my idea of the year for 2025. So far, it has not worked out super well. The stock's down about 10% year to date. A lot of that, I think, can be attributed to sector. The gaming sector has not been great so far this year. If you're on the YouTube, I've got a screenshot of kind of the most direct peers. There are some smaller peers out there, but, Full House is a lot smaller too. But Penn down 10% so far this year. Caesars down 15%. Boyd is actually up about 7-8%. MGM about flat on the year. So there's been a little bit of negative sector beta. And given Full House is the most levered of all of these companies on kind of just a headline basis, probably not surprising that they're towards the bottom. I personally, I've been reasonably pleased with how the year has gone for FLL. So if you'll recall, the thesis for FLL is this is a small cap company that through kind of a miracle, excellent operate, they are bringing online 2 giant casino projects inside of 24 months. So The one that's going to be the most valuable is American Place outside of Illinois, outside of Chicago in Waukegan, Illinois. They invested, let's round it up to 200 million to bring a tent, literally a giant tent. If you read, I've got the quote, it's the type of structure that your municipality uses to store salt for the winter. They opened a temporary casino there, spent about $200 million. That is doing phenomenally well. They're going to spend another about $300 million to turn that into a full facility. I believe all in, they'll have spent $500 million, and at the end of the day, it'll be a casino that does $100 million in EBITDA. So this, in my opinion, is the most valuable, most important project for Full House. And the good news here is it is doing fantastically well. At the very top of this slide, I've got a quote from their Q1 results. They are having record months basically every month right now. All-time record in March. April was really good. You can go look at the state level data. May was the second best month of all time, just behind March. The temporary is doing great, and I think there's every sign that once they open the full casino is going to do well. The other update on American Place is, if you recall when I did the podcast, there was, in my opinion, a nuisance lawsuit that stopped them from going with the full project. I was pleasantly surprised. In January, the Illinois Supreme Court dismissed the nuisance lawsuit, or ruled in favor of the Gaming Commission. So that takes the tail risk of, hey, what if the Waukegan license is lost? What if it's delayed indefinitely? That takes that off the table. The company can now, they're going to start building the permanent casino towards the end of this year, really get this thing done in 2026 and open in 2027. So the tail risk of, what if the license lost and everything, that's gone. Now you do have risks of financing and actually constructing it. Those are obviously big risks, but the tail risks are off. I think American Place is full speed ahead. I think the thing, if it does 100 million EBITDA, as I hope and expect, and I think the results right now are suggesting it might do better than when it opens in full, it's going to be worth all of the company's enterprise value and more, in my opinion. So that's doing great. That's ahead of schedule. The negative is Colorado, Chamonix. If you'll recall from the first podcast, this is the casino that they opened out in Cripple Creek. The Cripple Creek market was characterized by, there's a casino, Dynamite Dick's Casino. The Brass S Casino. Across the street is the Brass S Casino. The restaurant there is Dynamite Dick's. That gives you an idea of what the Cripple Creek market was. It's a penny slot play, people drinking butt heavies and playing penny slots. They built Chamonix, which is a upscale French luxury resort. They said, hey, we're going to build it. We're going to transform this market. I think if it's successful, it's going to be one of the highest multiple casinos in the country, because the dynamics of the market are so unique. It's basically a historical town. No one will be able to build and respond with a competitive casino. I was really excited about it. I've been out there. I think it's a great looking casino. It's ramped slower than I expected. Now, hard stop. It's slower than I expected, much slower than I expected. Slower than the company's expected too. The company, they fired the GM. They said, hey, he was over his head. In Q1, they did some undercover, guy undercover, getting to know the operation, fired the GM, brought in a new guy. It's going a lot slower than I expected. I was hoping for kind of next year after that, 50 million in EBITDA. At this point, I'd be pleased with 25 million EBITDA. I think the company still hopes to get to 50 million EBITDA, but it's one of those things, hey, we'll get there someday, kind of before the heat death of the universe. We think this will do 50 million EBITDA. So I think that's going slower. All in, I'd say this story is, American Place doing better, and that being the most valuable casino. Cripple Creek doing much worse, and that kind of being what I think would be the highest multiple, though not the most valuable, because American Place is going to do 2.5 times the EBITDA that Cripple Creek does. Slight negative, but I think the story's on track, to be honest with you. You've taken off a tail risk. American Place is doing great. I think the story's on track. The next thing here is, and the reason I kind of wanted to do an update on Full House, is insiders clearly see the same upside I do. This is a quote from the company's Q4 earnings call. You can read it. You can go look it up if you want. But the basics is the CEO, who, again, I'm kind of a fanboy of, all of my biases. The CEO walks through a bunch of math, and he says, look, when I put our model together, I kind of think we're worth $45 per share once all of this is said and done and everything ramps up. And, take some growth projects that I think are going to happen out. Take some time value money, whatever you want to do. It's hard for me not to get to $20 per share of value. Again, we're talking about a stock that closed at $4 per share. So if it's $20 per share value 5 years from now, and I think he's time discounting once he gets to that 20, that's a 5-bagger over 5 years. It could be significantly more. So I think the insiders clearly continue to see the upside that I see. And I would point to something that, look, there's words are one thing, but insiders are backing their actions up with one word. Eric Green, who is a director for the first time in a long time, he bought 25,000 shares at $3.40 per share in mid-May, right when the window opened up. That's not a small buy. That's $75,000 worth of 75,000 plus worth of stock. Eric made 62,000 per year of cash comp as a director. So more than 1 year's worth of director fees going into buying stock on the open market. Increases his stock ownership by more than 10%. So would I love to see more? Would I love to see every director just buying constantly? Yes, but this was a significant insider buy for a director who doesn't have a ton of history insider buying here. So that's one sign. But the really big one, the headliner, the one that I've been waiting to tell you guys all about is Dan, the CEO. On June 13th, my birthday, happy birthday to me, Dan makes a enormous insider buy, over 270,000 shares at $4.75 per share. Now, what's interesting about this? First, over 270,000 shares, let's round it up, 1% of the company he buys in one fell swoop. It's under 1%, but we can round it to 1%. It's well over 50 basis points of the company he buys. So this is an enormous buy. But did you read the price I said? $4.75 per share. I've got on the YouTube a stock chart of Full House Resort stock. The stock hasn't traded for $4.75 since March 1st. At the time that he does this buy, the stock is trading for $3 per share, right? So he goes out and he buys he negotiates, and I'll talk about the negotiation in a second. He negotiates and buys 1% of the company at a more than 50% premium to the prior day's closing price. And this is the same CEO who went on the Q4 earnings call and laid out the math for him to get $45. He said $45 per share in value. Look, if that's not actions backing up words, I don't know what is. And now you'll notice I said negotiate. If you read the fine print of the Form 4 and kind of dig around a little bit, he buys some of the shares for himself. He buys the majority of shares for a trust account for his kids. And who does he buy the shares from? He buys the shares from his ex-wife. And again, I don't know Dan. I don't know his ex-wife. His ex-wife is a member of the House of Representatives, so she's a political figure. And you can Google. The divorce looked kind of contentious to me. You can Google it around. It looked contentious to me. What divorce isn't, right? But I would just say, if you go and your ex-wife owns, and I think it had been drag on the stock. Dan kept filing Form 4s, and it was his ex-wife selling shares and everything. So he took her out of this in one fell swoop too. But I would just posit that if you've got a well-known insider figure who buys 1% of the company from his ex-wife, who he's going through a contentious divorce with, closes out the contentious divorce by buying 1% of the company and puts it all in trust accounts for his kids, which is very tax advantaged, which is why I'm saying that. There's a old Peter Lynch saying that is, insiders might sell their shares for any number of reasons, right? They might have a kid graduating, they might have medical bills, they might want to buy a house, all this sort. They might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise. Great, famous Peter Lynch quote, has survived for 30 years, very popular among value investors. I'm giving you my new Andrew Walker quote. I think it's better than the Peter Lynch quote. I expect royalties, if you ever use this, I expect it to be written about in books, scholars, hundreds of years from now, the human race, thousands, tens of thousands, millions, the human race will die out. This quote will live on, and I expect it to be, this is my legacy here. Insiders buy for only one reason. They think the price will rise. But they only buy from their ex-wife at a 50% premium to the market prices for their children's trust account when they think the stock will rise by a heck of a lot. That's Andrew Walker. That's my new quote. That's my legacy. That's what I want to leave you with. So look, that's Full House. Oh, I'm trying to end on my quote, and I've got one more thing I wanted to, I think one of the things that's holding the company back is they have to do a big refinancing. They need to raise $300 million of incremental financing, which probably means an entire company refinancing in order to get the cash to build American Place. And Full House, it's under $150 million market cap company at current prices. So I think people look and say, oh my gosh, it's a $600, $700, $8 million refinancing if they're going to raise that incremental money plus refinance all their debt. $150 million company, oh my God, that's really hard. I would just note that right alongside when kind of Dan makes this insider buy, he signs a new a new CEO contract that takes him for another 5-ish years. Lots of interesting stuff inside of it. But the one that I wanted to point out was this debt overhang. Dan will get a $300,000 bonus if the company successfully refinances the company's principal debt by March 30th, 2027. Dan has consistently said they're going to get a refinancing done without raising any equity. I think if and when the refinancing is done, there's two major risks on the stock at this point. Number one, the refinancing. Number two, construction overages at American Place. I think when the refinancing gets done, that's a huge, huge uncertainty removed from the stock. I think the stock will go up significantly if there's no equity raise dilution associated with it. I expect there will be no equity raise dilution associated with it. Dan is very incentivized for there to be no equity raise dilution associated with it because A, he just bought almost 1% of the company, and B, he's been saying for a while there will be no equity raise. Anyway, in his contract, he now gets a $300,000 bonus if they refinance it. I think they will get a refinancing done in the back half of this year. I think when that happens, that insider buy is going to look very, very prescient because I think the stock will go up by quite a bit as the market adjusts to, hey, refinancing risks off the table, dilution risks off the table. All we need now is the casinos to get built on budget, on time, and to ramp up. That's a big if, but I think it really takes uncertainty away. Look, we're 2 for 3. Sage worked out really nicely. I think there's more upside there. KROS worked out really nicely. I think there's more upside there. Sage upside we'll know in the next few weeks if there's a Biogen offer. KROS will probably take a little bit longer, but I think with continued shareholders saying, "Hey, I'm a concerned shareholder, and you're keeping too much money. Management's overpaid. The cash burn's too high for the assets the company have." I expect upside there. I expect upside at Sage. And for FLL, so far it's a loser. It's down 10% on the year. S&P's up, Russell's flat. Yeah, sucks, but this is a small microcap company. It can be a little siggy. I think there is a heck of a lot of upside over the next few years as the refinancing gets done. American Place comes on in full. The new GM at Cripple Creek kind of comes on and gets cost in line. I think there's a heck of a lot of upside, but it's not just me. It's the insiders. They're signaling constantly. They're saying they see the upside, and they're backing those words up with actions that share the upside. So, I'm really excited. It's been a little bit slower than I thought, but I'm really happy to have FLL as a big position for me personally. Again, that's my disclosure. I'm really happy to have FLL as my pick of the year for 2025. I think the back half of the year is going to make me look good. And if the back half of the year doesn't, I'm positive 2026 and 2027 are going to make it look good. And I think in the medium to long term, it's going to look like a really prescient pick. So anyway, that is my rambling for my mid-year updates. I am hoping that my microphone worked and I don't have to re-record this or something. I'm looking forward to doing a ramblings, talking to you guys in the next couple of weeks. I've got some really good guests lined up for July, so I'm looking forward to all that. Thank you for watching. Again, I'd encourage you, if you want to go watch on YouTube, you can see the slides and everything I was talking to. I'll include links to all the prior podcasts, all the open letters, everything that you want on probably anothervalueblog.com where I post this, but I'll try and get them in the show notes too. And thank you for listening. Thank you for watching, and we will talk soon. A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.